where I was able to develop this particular pattern. This is actually something that was truly out of my observation of trading in the market. And one of the things, like I say, this is some of the patterns that I have developed and learned. It's taken me literally close to 36,000 hours. 36,000 hours estimated of looking at charts and staring at the markets on an 8-hour basis for the last 27 years. So with that said, the bullish trade setup, the high close doji, we're looking to buy on the close or the next open after a new closing high is made from a previous bullish candle pattern, especially if it's a doji, and if we are against a key pivot point or Fibonacci target support number. Now, I put in the Fibonacci target support number because a lot of times we will see a coinciding, corroborating Fibonacci number alongside a pivot point. That's why I use pivot points more often than I use Fibonacci, because it's redundancy, and pivot point analysis is more effective because it combines both time and price, and as traders, that's what we need. We need to know where the market is going to be in a specific time frame, and then it's up to us to identify what the change in momentum is, and that's what the high close doji is. It identifies that change in momentum. Now, how do we place our stops? What's our risk factor? Real simple. We place stops below the lowest low of the initial bullish candle. In that case, it should be the doji. And that stop should be, again, a stop close only on an inter-day basis. You're going to have to use a mental stop close only. You want to sell or exit the trade on the close or the next open of a candle once we see a lower closing low, and especially if we're near an important key pivot point target number. Now, you can use a filter or a backup process to confirm the buy signal, such as a bullish convergence stochastics pattern or a MACD pattern, such as a hook cross or a zero line cross on MACD. But overall, here's what the high close doji generally looks like. This is a euro currency, and as you can see from the prices, this is not recent. But again, we're going to show more recent charts, and we're going to identify how the pattern occurs over and over and over again. We see a doji. We're at, you can't see the blue line, just underneath it at 132.87. We have right underneath this line is our pivot support. And as the market got close to the pivot support, we saw a doji. We saw the market close above the doji high. In fact, we see another doji. We see what? Another higher closing high over the doji high, and the market trails off. In fact, you think the top is in. Here's an additional confirmation of a failed doji top. Now, this is not a very small time frame. This is, again, a 15-minute time period. So this is not something that if you used a 1-minute chart, you'd see dojis almost every candle. I use a 15 and a 5 for my trading, and I think the 15 is the most reliable time period because it allows market participants, that gives them at least that 15 minutes. It's a quarter of an hour. It is 1/4 of a full hour of trading for the market to digest and create a range. And that is important. So that's why I personally follow the 15-minute candle patterns. But in this case, high close doji, we're looking for a close above the doji to signify the change in momentum in the market. So let's identify high close doji. We have doji here, we have doji here. We're looking for the market to close above the doji high. And see that we have the highest high of the doji. We want to see the market close above that level in order to trigger and signify a market move. Now we have another doji here. So notice that the market doesn't close above the doji high, it closes on the high. That's not good enough for me. I want to see confirmed evidence that there's a shift in momentum and that the market stayed and sustained a price breakout. And it won't do it by just trading above a doji high, because notice we have that here. It doesn't sustain and accept and lock in a higher price. It fails and comes back. How many people would be just chopped up alive in that type of environment? The key is to wait for the market to close, lock, and assign a higher closing value, and then based on that, we want to buy on the close or the open in the next time period. We use our last doji's low as our risk factor. We want to place a stop, friends, right as a stop close only there. Now, in this particular example, we'd be getting in on the open right here of this candle right there. We're going to place a stop right here. So let's review. That's 133.57. We're in at 133.65. We're not dealing with a lot of risk, are we? We're not dealing with a lot of risk at all. Now we're in, we want to see immediate results. The market closes higher. Next candle, we don't see immediate risk.